Let's just get straight into it. Today, we're diving into this explainer to figure out exactly how the Reserve Bank of India acts as the master mechanic for the nation's entire economic engine. I mean, we hear about inflation, interest rates, and liquidity all the time, right? But the actual mechanics operating behind the scenes, well, they can kind of feel like a black box. So today, we are going to unlock that box.
So think about this for a second. Who actually decides the price of your next bank loan? When you go apply for a car loan, a home mortgage, or you're just looking at your monthly EMIs, those numbers aren't just pulled out of thin air by your local bank manager. No way. They are deeply influenced by complex macroeconomic policy designed hundreds of miles away in the offices of the RBI. Today, we're connecting those abstract policies directly to your personal finances.
So, here's our game plan for today. First, the Inflation Balancing Act. Second, quantitative tools, so the volume. Third, qualitative tools, meaning the direction. Fourth, open market operations. And finally, number 5, the real-world impact.
All right, let's kick things off with Section 1, the Inflation Balancing Act.
The central bank is basically always walking this massive tightrope. They've got to foster robust economic growth, sure, but they also have to simultaneously keep prices stable so your money doesn't just lose its purchasing power. So the magic number here is 4%. Back in 2015, the RBI signed the Monetary Policy Framework Agreement with the Government of India. This literally legally mandates the central bank to keep inflation at 4%, giving them a 2% margin of error on either side. If inflation creeps above 6% or drops below 2% for 3 consecutive quarters, the RBI actually has to answer directly to the government, explain what went wrong, and detail their exact game plan to fix it. To hit that specific target, the RBI has a master toolkit. And it's basically split into 2 main branches. On one side, you've got tools that adjust the overall volume of credit, so impacting the entire money supply. And on the other side, there are tools that selectively influence the direction of that credit, making sure funds actually flow exactly where the economy needs them the most.
Moving right along to Section 2, quantitative tools, controlling the volume.
You can think of these quantitative tools as the heavy levers in the RBI's control room. They are literally the accelerator and the brakes for the entire economy's money supply. The most famous one, the repo rate. This is the rate at which the RBI lends short-term money to commercial banks, and it acts as the ultimate signal rate for the economy. When the RBI wants to pump the brakes on inflation, they just hike up the repo rate. The money supply shrinks, the cost for banks to borrow goes up, and well, they pass that cost straight on to you. Meaning your new car loan or home loan, it instantly gets more expensive.
Next up, we have the cash reserve ratio, or CRR. This is a specific chunk, a percentage of a bank's total deposits that they absolutely must keep locked away as cash with the RBI. And here's the kicker. Banks earn absolutely 0 interest on this money. 0. Just to put that into perspective, at current rates, this one single rule locks away trillions of rupees from the economy at any given moment. Tweaking this ratio acts as a direct credit squeeze or an expansion. If the RBI raises the CRR, banks just have less money to lend out, which immediately tightens the overall money supply.
Alongside CRR is the Statutory Liquidity Ratio, the SLR. And just a quick side note, you might hear the term NDTL pop up, net demand and time liabilities. That is just a fancy technical term for the total deposits a bank holds. Both CRR and SLR use this base. But while SLR sounds a lot like CRR, the big difference is that SLR is kept by the banks themselves, not parked at the RBI. Banks have to maintain this percentage in highly liquid, super safe assets. We're talking government bonds, gold, cash. Why? To ensure they always have a safe, liquid buffer to protect depositors, like you and me, from unexpected shocks. And of course, raising the SLR also shrinks the pool of funds banks can actually lend out to the public.
All right, Section 3, qualitative tools, steering the direction.
So if quantitative tools determine exactly how much water is flowing through the pipes, qualitative tools determine which pipes actually get the water. It's a crucial distinction. Quantitative tools adjust the overall speed of the economy. They're broad, they hit everyone. Qualitative tools, though, they act like a steering wheel. They selectively influence credit flow to specific sectors of the economy to ensure balanced growth and, curb wild speculation without necessarily shrinking the entire money supply.
So what are these directional tools in practice? Well, first, there's priority sector lending. This forces banks to direct a specific portion of their loans into vital but often underfunded sectors. Think agriculture, education, and MSMEs. Then you've got margin requirements.
This dictates the down payment you actually need for a loan, which helps curb rampant market speculation. The RBI also uses something called moral suasion. This is essentially the central bank persuading or advising banks through dialogue to follow policy directives, but without setting legally binding rules. And if that gentle nudge fails, they bring out direct action, which means slapping harsh penalties or restrictions right onto non-complying banks.
Okay, on to Section 4, Open Market Operations, Fine-Tuning the Liquidity.
If the repo rate is the heavy brake pedal, open market operations are the fine-tuning dials. It's the day-to-day mechanism the central bank uses to manage the exact amount of cash floating around in the banking system. And the mechanics here are elegantly simple. When the RBI wants to promote economic growth, they buy government securities from the open market. By buying up these bonds, they're handing out cash, immediately injecting the banking system with vital liquidity so banks can lend more. But conversely, if inflation is running way too hot, the RBI sells those government securities. Banks buy these safe assets, handing their cash over to the RBI and effectively vacuuming up all that excess liquidity from the economy.
Which brings us to Section 5, Real-World Impact, where policy finally meets your wallet.
Let's bring this all together and map out the critical steps of monetary policy transmission. See, historically, the RBI would cut the repo rate, but banks wouldn't fully pass those savings on to consumers. Frustrating, right? To fix this, the RBI forced a shift to a new benchmark called MCLR, the Marginal Cost of Funds-Based Lending Rate. Now, when the RBI lowers the repo rate, banks are basically forced to factor that variation into their MCLR. This ensures those crucial rate cuts actually reach your pocket efficiently, giving you cheaper loans.
But look, the system isn't always perfectly smooth. Take a recent real-world challenge. The Indian economy faced a massive, severe liquidity deficit that literally hit a 15-year low. To rescue the system, the RBI had to step in aggressively. They used their open market operations to inject a staggering 1 lakh crore rupees into the banking system through special auctions, and that was alongside a massive $10 billion swap. The sheer unprecedented scale of those numbers just shows you how fast the central bank has to act when the financial plumbing suddenly dries up.
And why did they have to act so drastically? Well, because a liquidity deficit basically derails everything. It drives up borrowing costs for vital businesses like MSMEs and non-banking financial companies. It completely delays monetary policy transmission. Without adequate liquidity flowing through the system's pipes, honestly, even the most aggressive repo rate cuts by the RBI become completely ineffective. Banks get squeezed, credit dries up, and investment just slows to a crawl. The tools only work if there is fluid in the machine.
Which brings us to a really fascinating frontier. We've seen exactly how the RBI uses its traditional tools, interest rates, reserve ratios, bond buying, to steer the economy. But with the rapid rise of digital payments, unified lending interfaces, and the potential for central bank digital currencies, the fundamental nature of money is shifting. So as the RBI embraces this massive new digital infrastructure, how will the future of money ultimately change the very tools in their toolbox? It's a pretty compelling question, one that's definitely going to define the next decade of economics, and something we should all absolutely be paying close attention to.
If you found this information useful, then please like and share the video. For more educational videos like this, subscribe to the Prashasan Paath channel today. Thank you.